I have spent the past 37 years in this business, leading the investment banking and markets and banking businesses of Citigroup for a number of years before starting our own firm where we advise typically large companies, large investors, sovereign wealth funds on various different investments, acquisitions, complex issues. And we, in 2018, as John has described and no doubt will delve into, we formed the first general partnership solely targeted on using public equity vehicles or SPACs to build value for shareholders.
Can you help us understand what's helped the market evolve?
2018 is when we made the decision to use our own capital as principals. And that came after we had both raised vehicles for other people. We had sold companies from Fortune 100 businesses to SPACs. And we had a very good awareness of what was both the extraordinary benefits of the SPAC as a tool, but also what some of the limitations were. And quite frankly, we made the decision when we got into this business to effectively not only utilize all of the great benefits of the SPAC structure, but also make some fundamental changes, which we helped or believe we helped eliminate or certainly address some of the weaknesses. Now, I'm really pleased that we found the product early. I'm also thrilled to see the current acceptance that the product has. And I give credit really to people like Bill Gurley, who's a great investor. And in August of this year, he essentially said that SPACs were a legitimate path to the public markets. And he described his so-called door number 3, that this was the third path, and that it had a real value, and that he wasn't going to be surprised if he saw very high-profile companies, in fact, using the SPAC as a path to go public. And that was, by the way, probably one of the most important recognitions by an investor group. But look, I'll say to you that we've known for a long time that there are certain real benefits to using a SPAC. And in 2018, we knew that one of the benefits was for investors. Of course, you have a redemption feature, that's well known. But for investors, you have an opportunity to review a transaction before it goes public with just much more detail than you have with an IPO. Certainly retail investors who don't have access to IPOs, but institutional investors as well. The concept of a proxy document, which is 500 pages and forward-looking forecasts and 3 months of marketing, it's one of the really unique opportunities is for investors to have a better sense of what they really will be owning versus an IPO process that comes together in 2 weeks with a small prospectus and very, very fast meetings with only the most important institutions. Now, for companies, we also knew that it was a benefit because companies have the ability to negotiate directly with a SPAC partner and have the ability to not only set a value, but also use this mechanism of a merger proxy to put forward their story more clearly. But to be clear, we knew up front that there were also some real limitations. And when we started our business in 2018, we wanted to address those limitations incredibly directly. So the first was the issues that SPACs had, as I think most on this call know, and many of you are either investors with us or hopeful investors in situations that are being bandied about. You knew that one, the SPAC didn't have the commitment to close. It didn't have the capital that was guaranteed. Secondly, there was dilution from the founders' capital. And as a result, you had negative selections. And we made a decision, John, to eliminate those issues. And I can spend more time on it. And I want to make sure I address the issues that you want. But in 2018, what we did right up front was, one, we pulled together committed capital. So we made a decision that we were going to invest in every one of our transactions to make sure that any announced transaction was guaranteed to close and that we were ourselves direct equity investors. And in each situation where we've raised capital, we've put significant IPO investments in, and more than 50% of the public float is owned by a core group of investors that we have a very close relationship with and in some cases are part of our partnership. That's typically 10 investors that control the vote. So we can guarantee the closing of a transaction, which we've done in basically every situation. The second thing we made the decision to do is that we would invest our capital at a higher price than the public markets. So we undid this fear of dilution by essentially being clear that we would only get our capital if the stock got to $15 in the Clarivate case in 2018, $12.50 in some of the other cases. We also have committed to hold for the long term, and we've committed to bring together value. And this, I think, is, for those of you who've been investors know this, we have 19 CEOs of Fortune 50 companies who are investors and partners with us. We have invested, we've raised $12 billion. We have $45 billion of public market cap value in the companies that we've helped create. If you were an investor in all of our IPOs, you've had a more than a 100% annual IRR. We put more than $2.7 billion in the initial investments to work that are worth over $5 billion and change. Because we've been reviewing situations for one vehicle or another since 2018, we have 4 years worth of, if you will, targets that we have been exclusively analyzing with our team and working to create public capital markets value. And that puts us in a position that we get to be incredibly selective. And we get to be incredibly selective because we have to put money in. We've put $1.5 billion of our partners' capital to work. We only take our equity when the stock goes up. We hold for more than 3 years, and we bring leading CEOs and operating partners either to be chairman, CEO, president, or lead the board of the company.
Michael, as far as the immense amount of SPAC issuance we've seen, what do you think about the quality of the sponsors, the individuals behind these SPACs? Is that critical?
There is an ecosystem of 50 or 60 hedge funds who have been created principally to invest in SPACs. And so that none of you are caught unawares, those hedge funds have the ability to leverage 6 or 7 times their capital from their prime brokerage only until the redemption date. It's very important to keep in mind that because of that, they can buy 7 or 8 times the amount of capital they have. But when the redemption date comes, they go back down to margin leverage. So it means they can't hold but 1 or 2 out of 8 that they own. That's a rented capital pool. That rented capital pool means that the vast majority of these 200 or so SPACs have really no certainty of capital. What they have is their reputation, their small at-risk capital, the work of their underwriter, and the hope that they find a very good transaction that they value in the correct way. That's the first. The second is because the market accepted a change in structure where underwriters were willing to take only 2% of their fees up front and put the rest of the 5.5% to the back, there's a lot of people that can afford to put in that sponsor, quote, risk money when it's only 2% of the capital raised. That also creates a different structural incentive because there's a huge deferred fee pool on Wall Street today. With circa 75 billion raised, there's $2.5 billion of fees that are waiting for transactions that close. So the SPAC issuance is probably, on the one hand, it's quite a good ecosystem that means more companies will look and use those tools. But by the same token, for investors, they have to be mindful that if they're not one of those core group of investors that are essentially controlling the vehicles, they have companies that may, or investment entities that may not have certainty of closing, may not necessarily have good deal flow because they haven't been in the business of looking for transactions. They may or may not have capital to help close or operating expertise to drive. Some are, and some won't. I certainly wish all of them successful. It's better for the whole system to be productive and add value.
Going back to 2018, the first Churchill SPAC, you didn't see as much action in these pre-revenue companies. These days, electric vehicles, space exploration, that sort of stuff is all the rage. How do you feel about that when you're looking at a company that might make a whole lot of revenue 2 years from now, but is still just ramping up?
We're looking at companies throughout the entire life cycle, from very early in their development to very later in their process of being leverage buyouts and needing deleveraging to grow. We had the benefit of being able to, on Skillsoft, use a debt restructuring to eliminate $1.5 billion of debt before we even touched the asset. We drove that for our own benefit, and the company partnered with us in doing that. But we look at the whole life cycle of companies, and what we stick to fundamentally is, one, companies that should be public will take public. You can't bring a quote company that should always be private in the public. It has to have tailwinds in the industry sector. It has to be a growing company organically and or have the ability to grow inorganically. From our perspective, it's not our job to take a technology proof bet. That's not what we think is appropriate for the public markets. And I do think some of the SPACs that are out there who will be taking a bet that is much more binary on technology, that's an area of risk that investors, I think, are not expecting, because venture capital, as you know, has a portfolio. If you have 20 investments, 3 of them may be home runs and 10 of them may be really bad and 7 may be okay. But that portfolio math means there's whole sectors in mobility in particular where many of the companies just will not have the technology to be the replacement in short distance travel or air travel or go through it. But there will be winners, and there will be very big winners. And if we believe in the company, if it's proven out its technology, if we believe in the management, if we believe that we can set it up at an appropriate value for investors, if we believe we have operating partners that can drive value, and if we believe in the company, we'll make that investment.
Do you think it was a couple of marquee SPAC deals that caused this shift towards these very high growth, often pre-revenue companies? I'm thinking Virgin Galactic, perhaps. And will that persist, or do you think that there's likely to be a shift back towards stuff that doesn't look so much like public venture capital?
Yeah, well, that's a great question, and I would say first and foremost for everyone that's involved in ICR, who's a really wonderful investment relations firm, anything that you see us do, we will have massive conviction in the growth and the value upside. And we don't differentiate, if you will, between something that was owned by venture capital or private equity or owned by a family or owned by a company. Because we have these 20 CEOs that are so well respected, the shift has been towards growing companies. And the only question, John, has been how fast growing and how early stage and how much risk you're prepared to take. And with the detail of the proxy and the longer term private diligence and the longer term marketing, you get a lot better information, regardless of whether the company is really early stage or a little bit later stage. But the risk that's being taken by some before a technology is proven is a very different risk. But the transaction, and Virgin Galactic, where we represented Richard Branson on the merger of that to Chamath's vehicle, that was very successful. It's hard for people to remember, but it actually wasn't successful at closing. There was, I believe, of the 700 million, only 300 million stayed in, and then 100 million was added by Chamath. So it was a struggle, and in fact, right after the closing, it dropped. So it was a tough play at the time, but there's a bunch of things that changed for that. One was, of course, the explosion of some of the retail investors. Secondly, there was a really seminal report by Morgan Stanley sometime in the early part of COVID that essentially said, look, we can't predict where the economy is going to go this year or next year. But if you've got an investment in a company like Virgin Galactic that's going to show value in 2024 and 2025 and isn't impacted by COVID, that's a safer place, which is a perverse thought, but a safer place to put your capital.
What's your thought on how important pipes are and whether or not demand from pipe investors is going to continue to carry the market?
The pipe is essentially a private test run for an IPO. So if you're a company that doesn't have a commitment, and you let one of the sponsors go and do an IPO test and it fails, then you failed on your IPO. And if it succeeds and you get the biggest investors that are institutional names to come in, you really want to make sure that they're only coming in with a part of their investment, and the rest of their investment they'll buy in the public market. Because allowing those investors to just come in at $10 when everyone else is hopefully buying in at 12 or 14 or 16 or 18 is actually not the best tool for SPACs. It has become de rigueur because it's their way of getting to certainty. We took a different view. We made the decision that our base vehicle should have certainty, that our base vehicle should be funded and we give 10%, 10 investors own 55%. Typically, 2 of them are on our board. The next 10 investors get us to 80%. So with 20 calls, we can have certainty. In the multi-plan transaction, as an example, we had a full commitment for the full IPO as part of the transaction. With Skillsoft, with Prosus now committing 500, that's a main shareholder that's committing to fund the entire cash condition. So the pipe is a crutch on the one hand to make sure you have cash, on the other hand to pre-market and market test for the SPAC and for the underwriters, it has good benefit, but it does take away some of your best buyers from the market. And if you can find certainty without it, that's better.
Any predictions for the SPAC market in 2021? And can you give us any thought on any sectors that you think make more sense than others?
We looked at 200 companies since the pandemic started, more than 100 non-disclosure agreements. 90, I think, of those were exclusive. We still have 50 projects that are in the pipeline of our teams today, the vast majority of which other people aren't looking at. It's just us. So we have the ability to be highly selective, and we made a real choice on Skillsoft to do something that others weren't going to do. We told the company in March of this past year that we would only buy the company if they went through a debt restructuring before they gave the keys to us, if they eliminated their private equity sponsor, if they completed not just audits, but rolled out a new technology. And if they would do all of that, we would invest at 6 times cash flow and 10 times earnings. So we do that hard work because that's what we can do to create value. And we spent over a year, tremendous amount of time and money and effort from lawyers, consultants in our team, and they might not have achieved the goals that we set for them, in which case we wouldn't have gone forward with the transaction, but they did, and it's going to be a massively successful transaction. So we see in 2021 the business models breaking down into 2 kinds. One kind is what I think is value added, and I think we're in that. We believe that we're creating value with our capital, with our operating partners as either mentors or driving value, with our ability to stay with the company and drive investor knowledge and continue to build. We've helped Clarivate with acquisitions every step along the way, as an example. It's a separate company run by Jerry Stead. It's his business. It's separate from Churchill. I'm not on the board, but we help them because we're big investors and we remain big investors. So those value add players, and there's certainly people in the market who've done interesting things where they add value based upon either their skill set or their network or something that they bring to the party. It's the extraordinary minority of the players. I don't believe that celebrities and politicians are great things, but I don't believe that drives the value add from a SPAC side. The second that I think will do well is there are people that are in the technology world that will have the ability to do very little for the company, but just simply give their vehicle to the company in exchange for the company going public. And for that, they'll give up pieces of their economics. They won't need to stay on the board. They won't have governance. They'll let people have AB shares. They'll do all the things, but they'll use the fact that they created the vehicle and paid for the underwriting to let someone go public through that way. And some of those will work out, and some have worked out, by the way. But those 2 sections will be, I think, a number of companies per year. The middle, those SPACs that don't have that unique access and don't have value add, will, I think, have a much more negative selection bias. And then in the industry spaces, I think you just have to look at economic activity levels and relative valuations. I learned a long time ago that for something to just be cheap, it has to be extraordinarily cheap, which means 10 times earnings, like we did with Skillsoft. That's just dirt cheap. That you just don't ever have a situation like that for a quality company that's growing. But leaving aside cheap, the only companies that are going to work are going to have unique organic growth that comes from their industry, comes from their unique market position, comes from technology that they've proven and that they've already got scale, or you can see the scale coming in front of them, that have the ability to drive earnings over time, that it yields real cash flow. And also the second group are going to be those that are in fragmented industries where you can see great consolidation. The SPAC tool is a tool that companies and investors can use as a very important piece of the capital markets. 2020 probably was the year that that was confirmed. 2021 will be the year that everyone asks the question, can it continue, or was it a bubble? I think you'll find that it will continue for many, but not for all of the participants.